things.
There was other uses they could do, or other?
Oh no, so as I understood it, they actually wait. They make like a bet, right? So they wait to book the ticket, thinking that the price is going to come down.
Right.
We were saying it sounds interesting, but you know, obviously some stress for the user in knowing the ticket's not booked, and if they're wrong, would they have to eat like $1,000?
Yeah.
But I don't know. I'd love to dig into it. I thought the concept was really interesting.
Yeah.
You know, the idea of I'm paying the price now. That price may go down, but it's never going up.
Right.
I like it.
Interesting.
I think the logistics 3PL company.
Yeah, the
Slashdot, was it? No.
No, you're talking about Whiplash.
Yes, I think if presented right, there's a need for next generation 3PL out there that can work with all these companies that are leveraging Kickstarter, and we went through challenges at Fab with our 3PL and ultimately had to build our own facility out.
What was it called? What was the term?
3PL, third-party logistics company.
Oh, I didn't even know that. 3PL.
Yeah, so that's like the space that they're in, and there's a lot of those outsourcing companies out there.
But they're not internet companies. They're
been around for 20, 30,
50-year-old
50-year-old, and you know, they take stuff, put in a box, and you know, maybe they take an Excel upload, or if they're advanced, they have an API, but they're not what we're accustomed to in this industry at this point.
Interesting. What else did you guys like, Wesley or Mamoon? Did you see any of the other ones?
Well, I've been wondering the hall outside, because that's always sort of one of the funnest things, is to see who's out there and who's sort of...
Oh, in the demo pit.
Yeah, in the demo pit, and it's great. I was catching up with, I think, a company called Rockbot, which does music for businesses. You know, today, you know, most of the music companies that I see tend to do music for consumers, Spotify, Pandora, and they're actually addressing a market that's heavily disruptive, which is what do you play in your bar, in your store. And there's a company today that does, I think, $750 million worth of business today just by selling businesses CDs. And to be able to sort of give them a web model where you can play, you can have users pick songs, it's pretty cool. And you know, it's just sort of disruptive and revolutionary and sort of fascinating to sort of see the new business models that are out there. Sort of, and it's an enterprise company, which is the topic of this discussion. So
let's start with the fund you actually have. We had a good discussion last night about there's a dinner that occurs the day before the event that I think almost all of you are at, which is the angel dinner, where one of the founders and 60 venture capitalists and angels get together and just have dim sum. We're talking about Google Ventures as an entity. It's 3 years old right now, I think.
Yep.
And it's $300 million a year.
Yeah.
There's 7 partners and maybe upward of 100 people working there.
It's about 60 now.
60 people, $300 million a year. Why is Google spending $3 billion over the next decade doing venture capital when they're a search engine company? Explain how you got Larry Page to do this.
Yeah,
and Sergey.
You know, the most important thing to sort of realize is that Google Ventures is an independent entity from Google. When I am asked to invest, I invest in a company because I believe it will both change the world and it will make money. And those are the two most important things. If it's competitive with Google, if another company that's a competitor to Google winds up buying them, Google is fine with it. The incentive structures are set up in such a way that I get paid when a company makes money, when it exits to something. It doesn't have to be to Google. It can be to Twitter. We have a company that exited Twitter. But it's important that Google start a fund that gives back to the ecosystem. Larry and Sergey were funded by Sequoia and Kleiner Perkins when they started Google, and John Doerr and Mike Moritz were just so helpful in helping them get their business started, and they said we should apply that same sort of expertise in helping us get started to the companies that we invest in.
So Google Ventures is the thank you to Kleiner and Sequoia?
I like the way you put that. That's hilarious. No, it's a thank you to the entrepreneurs, which is the important thing. I mean, without entrepreneurs, there would be no Google. In the same way, just for companies that are starting today, it's very important that we fund that ecosystem. Some of those entrepreneurs could become Google's customers. That's not a reason why Google funds it, but there's all these sort of secondary effects that become really important. But there's some good companies out there that we've invested in that do biofuels, cancer treatments, things like that are just sort of super important that have a huge impact on the world.
So Josh, how does a Draper, Fisher Jurvetson, DFJ look at Google's entry into the market 3 years ago? Is any time a very well-respected buyer, M&A-wise, and a player in the space, is it concerning that they have a venture firm, or is it delightful to someone like DFJ? Do you guys compete for deals now, or is it more collaborative? How do you look at a Google Ventures?
Well, so I think Wes is right. They've been very consistent about keeping it separate. So they treat it like a real VC firm. It doesn't mean that you have to work with Google or you have to sell to Google, and they really are, I think, they operate like a traditional venture firm. I also think they've been a real leader in this model of how do we add services beyond the money. And I think a lot of the traditional venture firms, us included, have seen that and see the wisdom in that and are building up some of the same services in a more structured way. So I think they've actually led the way in a bunch of the stuff. I think we have been pretty consistent. Anything that puts more money into the ecosystem and allows entrepreneurs to pursue ideas, we're in favor of, generally.
Let's unpack that idea of additional services from VC firms, because just 5 years ago, meeting with a VC firm, you could expect meetings, you could expect board meetings, and somebody to call. And some VC firms had a recruiting partner and maybe a marketing partner. I know when I got money from Sequoia, they had one marketing partner and a couple of people doing recruiting, so they'd help you with talent. And that's obviously one of the best firms, historically. Now it's changed a lot because of Google Ventures. What are the services that Google Ventures is providing, or I guess Andreessen Horowitz is pioneering this as well, that now Draper is looking at going, we need to provide more?
We mentioned that there were 60 plus people working for Google Ventures, and most of the people aren't investing. They're helping our portfolio companies out. We have 5 or 6 people on our recruiting team who do nothing but source engineers and help our companies hire the best engineers. We have a bunch of data scientists that help our companies understand insights. Those are things I appreciated when I was an operator. When I started Google Analytics and Google Voice at Google, I had access to some of the best UX designers in the world, helping me build out what is now Google Analytics and giving that to our portfolio companies. Again, it is a thank you to our, to the folks that helped us at Google build up the company. Now we want to sort of say, look, these resources are at your disposal in building an awesome billion-dollar business. And I think some of our founders appreciate having access to some of the best talent in the world, whether it's on the recruiting side, the marketing side, or the UX side, where we have a design studio that helps them figure out how to reduce the friction in their paywall.
So Jay and Mamoon, how does Zelkova and Social Capital Partnership look at this? Do you guys say, oh my God, Social Capital Partnership has to have 7 recruiters to keep up with the Googles of the world? Or do you say, we have a unique value proposition and what we do, it's enough?
Yeah, so to your first point, I think we work very collaboratively with Josh's firm and Wes's firm. And I just got an email from an entrepreneur who got funded by Google Ventures and us, and he thanked us for the space, and he thanked Google Ventures for the cupcakes you guys sent over. But I've also heard a lot of entrepreneurs saying, hey, the recruiting is phenomenal, and we've got other co-investments where your recruiters are really sending over lots of resumes, and that's been invaluable. So, I think we've learned a bit, and we also have some talent people in-house who help with engineer recruiting. So they sit at Social Capital, and they're doing our in-house sort of mostly around technical and product people, as opposed to traditionally, you mentioned in the past, you'd have a recruiting partner would help with executive level hiring.
The CEO, president, COO.
Less of that and more of the technical engineering product related hiring is happening at Social Capital as well now.
For us, our structure allows us not to have to invest. So we try to only invest in companies we can add value more than just money. The other unique thing about myself and what we're doing is, I'm an entrepreneur myself and I have a startup at the same time. And that adds a very different perspective at times. And it's given us the ability to actually, I hate to use the word use, but use a lot of our companies and be a little bit less of a Monday morning quarterback and actually a customer.
So you're spending half your time investing and half on your own project, or some combination of that, like
yeah,
Tony Conrad.
I haven't split up the time that way, but it's pretty much that it comes out to be, yeah.
I think Tony Conrad from True does that as well. He's running About.me and he's doing venture investments, which seems like an interesting model. Let's talk about enterprise, which was what we sort of put this panel down as. I'm also fascinated. Can I see the socks of the 2 gentlemen at the end here? I'm noting that
color socks are the next
Mamoon and Jay both have rainbow socks on, which is, I think it's going to be a trend. Regular socks. Okay, so 3 out of 4 VCs prefer rainbow socks.
Wait, these aren't
I
rainbow.
think we're seeing here.
These are very
Can we hold those socks up, Mamoon? Let me see those socks. Get up a little higher here. I want to get that photo of those.
Which ones? These ones?
Yeah.
Look at all
Rainbow socks pastels. These are really nice.
It's
You went with a pattern, and then you've got also
it's time to move on from these socks, guys.
This is I'm discerning a pattern. Yeah. Let's talk about the enterprise space. We saw Yammer on this very stage 5 years later, $1 billion exit. You guys were an investor in it. Dropbox, Box, Zendesk. Man, enterprise is crushing it. What exactly is going on in the enterprise that's made these sort of zero to heroes, it seems like it takes 3 or 4 years for these companies to get to $25 million in reoccurring revenue, which dwarfs the consumer space. Is it just that much easier enterprise now?
Well, I guess I'll maybe just at a very high level, there's, I think we probably all agree there's 3 major things that happen, there's the cloud happen, then BYOD happen.
BYO?
Bring your own device to work.
BYOD, yes.
Yeah.
Bring your own device to work.
And then along with that, mobility happened. And that sort of fostered this whole bottoms-up adoption of lots of easy to use, easy to adopt products like Box, Dropbox, even Zendesk, which is not really a consumer or a individual app. It's more of a used by a company for customer support, and Evernote came. So this whole bottoms-up adoption really happened in the enterprise, which has yielded companies like Yammer and Box, and to some extent Dropbox, which is a bit more still consumer-centric. And those trends continue. Those vectors continue to be important for us as we look at companies that are now thinking about, cloud happened, but now mobility has happened. How do you re-envision applications for mobile for the enterprise? And how do we invest in companies that are thinking about it mobile first? So like a CRM company. So how does Salesforce now get disrupted? Salesforce being a SaaS company, how does a CRM company now thinking about a mobile first mentality disrupt Salesforce?
Wow. So this first wave of enterprise, people are looking at them saying mobile might disrupt them.
Right. And so even the boxes and Dropboxes now could be disrupted by the mobile first, and so there's always a wave, and dislocations in the market happen, and mobile is the next dislocation in the enterprise.
I mean, so first of all, in enterprise, you've got huge dollars, and traditionally every platform shift has created an opportunity for upstarts to displace the incumbents. The thing that was different about both mobile and about SaaS, where the application is delivered through the browser, is for the first time it changed who the buyer is. So enterprise technology was always bought by IT or the CFO in a centralized way. You had to spend a lot of money on a pilot or on a full deployment, and it was bought in a top-down process. Now that the software is delivered through the browser and you can sign up with a credit card, it's become much more like guerrilla warfare. So you see something like a Yammer or a Box where the deployments initially are a single user, maybe 5 users or 10 users, and maybe there's 20 people within a company or 20 work groups that are using the product, and then IT or the CFO gets involved and says, hey, we should control this. And it's a total change. I mean, it's borrowing a lot of the playbook actually from consumer, but that's, the enterprise giants had no idea how to react to that. If you're an Oracle, one of your biggest strengths hasn't been technology, but that you effectively controlled that buyer. Except for now, there's all these roots around that gatekeeper.
I mean, it's effectively bring your own service, right?
Right.
Which I'm super excited about. I mean, just the companies that Google Ventures invested in, that model is just prevalent in terms of how the adoption is taking place. You're not doing the pilots anymore. Optimizely, which does A/B testing, very similar to Google Analytics. It's no longer a 3-month pilot selling to a central marketing organization or to the CIO. It's one person that's an associate or an analyst going, wow, this is different than any of the tools I have access to. Let me go put this on and try it out. I'll put my credit card, I'll expense the $30 a month service. And then after they succeed with it, they show off to their management team, they show off to the organization. It suddenly spreads like wildfire in the organization. That's a unique thing. We saw this happening in consumer when people could start deciding what they wanted on their own. We're seeing it with mobile, with the iPhone, and now we're seeing it in enterprise.
In a way, Gmail was the same thing. I mean, people had Outlook or whatever, and then they just started in a rogue way forwarding their emails to their Gmail account and changing the sender.
You used to have to go through CompuServe or AOL to get your email account. I remember back in the days when I was in college, I had to use whatever people provided for me. And then Gmail came along and you just chose whatever you thought was better. Yeah. And that choice that is now all across enterprises is very powerful. And I think that model is going to be very lucrative.
Do we think what we're seeing is revenue destruction and permanent revenue destruction, or the amount companies will spend on IT will stay the same? So if you're getting Yammer for $4 and Lotus Note $4 a month, and Lotus Notes was $400 a year per seat, and now you're at whatever $5, $60 a year for Yammer, or $50 a year for Yammer, is that a permanent reset of 80% of the value of Lotus Notes being gone, and that revenue is never coming back to the collaborative space, or are these SaaS companies going to lull the IT managers into $5 a month per person, and then it winds up at $50 a person.
Well, you have, I mean, there are apps that cost a lot more than $5, right? So Salesforce, can be $150 a month per user, and the $400 would probably be more of a license fee than an annual. So I think you're always going to be, one of the things I love about the enterprise is you can sell to value. So if you can sit down with a business buyer and say, by using my software, you're going to generate $50 million in savings, and I'm going to charge you 10, you're going to win on that argument every time. And I think the other thing with SaaS and cloud is you're broadening the market significantly. So if you take something, Salesforce's great genius was they took the market that Siebel pioneered and they expanded it by an order of magnitude by bringing the price and the accessibility down. We then invested in a company called Sugar CRM, which took it even an order of magnitude further by going to free. They said, hey, you want something that's 80% as good as Salesforce for free? Here you go.
And how is the sustainability of that now? Like a Sugar CRM, do people look at it and say this is versus Salesforce viable? And do at a certain point people look at it as that's the on-ramp to Salesforce, if you catch what I'm saying?
Well, I think, in the enterprise, you're always going to have different tiers of products. It's actually interesting. In the case of Sugar, they have a huge foothold across the smaller set of companies where price and value is very important. And interestingly, they're a little bit of a anomaly in that because they have a single tenant product where you can run it on premise, they're also very popular at the high end of the enterprise where they're taking over a lot of the space that Siebel left and that Salesforce's product doesn't work for very complex integrations, for example. So it's this kind of weird bookending thing. But I think what you're seeing is this market opening really wide. And Mamoon hinted at it earlier. We're seeing all kinds of new takes on CRM, mobile-first CRM, things that are connecting to outside data sources like LinkedIn to supplement the data. There's just all kinds of stuff going on there.
I was actually talking about this with a friend backstage about how enterprise sales has fundamentally shifted from big companies responding to expensive RFPs down to you try it first to bring your own service model. Big companies like Oracle are selling. Their bread and butter is to sort of very, very expensive enterprise sales to large companies. And you're seeing companies come in and disrupt because they're selling the bottom of the market where you can try out at a $30 price point and then sell eventually to an $8,000 price point. I mean, Optimize is an example. You get started with A/B testing of a product that's $30 a month. But most of their money and a lot of the bulk of where they're adding value are customers in the enterprise sort of tier paying $8,000 because they've upgraded and they've seen that value sort of spread across the enterprise. Because like Josh said, you can sell to the value of the product when you help people understand how much money you're making them because they're running or using your service.
I think going back to one of your first points, the other thing why this space is hot from an investing perspective is I think the entrepreneur who starts these companies, it's very different. It's typically comes out of a need they saw in business. They know there's a market for it. It's not your next social app that maybe people will like, right? So the risk profile of these investments can decrease significantly the cost of that in some way.
What do you think overall the business to consumer versus business to business space, failure rate for VCs will be, out of 10 companies? And I'm going to include failure as a push. In other words, you got your money back, it was an acqui-hire, and you were even. So complete failure, washout, short sale, and getting just your money back is a failure. Having a positive return greater than the S&P is a success. Is it 3, of 10 will be a success in enterprise, or 4 of 10, or 5 of 10? How do you guys look at it today?
It'll be lower. I would say the barrier to entry is slightly higher than building a consumer app.
So it's more expensive to start?
Yes, and more expensive to start, more expensive to get to first customer. But once you get there, there's money to be made. There's recurring revenues, especially with SaaS businesses. So the challenge then becomes can you sort of go into a mode of hyper growth once you've achieved some revenue and early success, and then can you become a Box or Yammer and fall into the hyper growth mode? And the challenge I would say is the biggest challenge I would say is do you become a software company that becomes a $20 to $30 million software company that's in this walking dead zone, or are you able to grow to become a $100, $200 million revenue company that goes public? So, and the verdict is still out on SaaS companies of that ilk, of the companies that
the 20, 30 million
the tweener
revenue, the
tweener that maybe gets acquired or it just kind of stays.
But wouldn't those acquisitions be great, or do the bigger IT companies say, I don't want this tweener because it obviously hasn't broken out, therefore it's got a scarlet letter on it, and a scarlet letter with 20 million in recurring revenue?
It's not bad. I think Oracle tends to buy those companies day in, day out. IBM does too. So there are probably some good exit paths for companies of that sort as well. But I think we're all looking for companies that have that hyper growth potential. And but I would say the failure rate should be overall lower.
So just quickly, failure rate versus business to consumer. What if you had to put a factor on it? 2 or 3 times less likely to fail?
I would say that I think your failure rate's probably going to be something like half. I think once you have companies that are paying you in a reliable way for your product. Let's say you've got more than a dozen customers, so it's a real product, not custom code. And assuming you don't have some ridiculous churn rate, you should be able to make a go of it at that point.
Yeah. The challenge is not making money. Unlike consumer companies, the challenge is how do you scale it beyond $10 million recurring revenue? That scaling is the difficult part.
It's very math driven, to be honest. I mean, when you get to a certain size where you have a number of companies, you can say, what does it cost me to acquire a lead? What does it cost me to close a sale? What's my churn rate? What's my upsell rate? And there's various points where the companies will get stuck. One of the things Mamoon was talking about at 20 to 30 million is, if you have a churn rate of, let's say, north of 15% a year, and you're doing that much, you've got to do $4.5 million a year in new bookings just to stand still. So at some point, gravity catches you if your churn rate is too high, and that's going to happen to every company at some point. So there are these sort of obvious places where you get stuck. As you clear each one of those hurdles, I think investors, both in the private and public markets, have gotten pretty sophisticated about understanding what the implications are long term, and that's why you see such high multiples for SaaS companies right now in the public markets, for the great ones, like a Workday.
Interesting. So are there too many people pursuing the opportunity now? It feels like the word is out because of Box, Dropbox, Zendesk, Evernote. There seems to be way too much success right now in this space. Are you guys seeing too many, the 8th, 9th, and 10th, cloud storage, the 10th, 11th, and 12th help desk software? And is it sustainable to have, 25 different people making, help desk software, or is it absolutely have to, because it seems like these tweeners could keep going and be incredibly profitable, which is sort of what the 80s were like for desktop software. Is it going to be like the 80s, or is it going to consolidate down where Microsoft Office and somebody just consolidates the whole enterprise suite into one?
I would say that the word is definitely out that enterprise is hot, and what that means typically for us is that, yes, there's a lot more activity, more companies. I would say there's less of the nth, cloud storage company or the nth Zendesk. It's more about what's beyond Zendesk and what's beyond Box already. That's what we're seeing is entrepreneurs already thinking about, well, now you have Box, Dropbox, Google Drive. What's the next thing? You've got all this cloud storage layer, and Yammer's got this. So how do we tie into all these things and build another company, enterprise company, a layer on top of? So rethinking things. We're seeing that, which is exciting. But I would say that it's activity level is high. I would say that folks who were doing consumer companies are now moving into doing enterprise companies.
Get your ass kicked in consumer, go to enterprise, get some wins under your belt.
Seen a few of those people who were on the enterprise side coming back went to consumer and coming back to enterprise now, which is a little shifty to say the least. But we like to see entrepreneurs are solving a pain point that they're seeing, not rather than what the market is telling them they should be seeing.
Right.
I mean, I think you see this in investing where things get hot. Right now, I think the imbalance is right at the Series A, which, by the way, looks more like a traditional Series B because you have seed rounds, where I think people are relatively overpaying too early for progress. I think the companies are still generally good companies. I think entrepreneurs have always done well to optimize around finding investors who obviously are going to pay a fair price, but also have gone through the specific experiences. And there are a lot of commonalities from one SaaS business to the other, especially on the sales and marketing side in terms of how you think that through. So, I mean, that's, I think that the prices on the A rounds have gotten a little out of control, but I think it's going to work out.
And as a VC, when you see the A rounds getting extremely high, and you see so many people not being able to cross the chasm between angel round and A round, does it make you think, God, I could get 4 for 1 on the angel space here and work with more companies? And is that math actually occurring in VC firms right now? Like, this person wants a $30 million A, but these teams are just as good and they just haven't hit it yet.
So you know this, I mean, you've been there. The problem with raising too much money at too high a valuation too early is it kind of locks you in, right? So you hire a lot of people, There's all this pressure and expectations. And it's like you can't pivot the way you need to be pivoting at that stage before you really have the data.
I've been there.
And it's a hard concept to explain to people that haven't seen it firsthand. How they say, well, how can too much money at too high a price be a bad thing? And the answer is because it really locks down your options. You start looking more like the big companies you're trying to disrupt, and not like the scrappy startup that can pivot strategy in a afternoon meeting.
There's enough challenges in a startup. Why bring on another one that you can manage and not have to bring on, right? And it can really, hinder your ability to raise future funding and be successful.
There's been a lot of talk about the returns of VC funds. Like Chamath was sort of going off like, 99% are not beating the S&P. We know it's not that bad. But is the venture capital space as broken as people are saying it is? Or is it just people like, we can pick on VCs, it's kind of fun to do, let's just, VCs are out of favor right now, it's all about the entrepreneur. It sort of goes in waves, right? VCs become gods, then they become, pariahs, back and forth, just like entrepreneurs. But is there a fundamental problem in venture capital, or is it awesome that there's so much money available and so many people get to swing the bat? It feels to me like there's a lot of great VCs out there doing a lot of great work.
So I would say there's the haves and the have-nots in the VC world. And success begets success, and there's folks who get into a virtuous cycle, and there's folks who get into the vicious cycle, the vice versa, right? So,
what causes that for VCs, do you guys think? Is it reputation now? Because it feels like with the funded and the sort of transparency of entrepreneurship today, and you've been in it for a while, Josh. Like, VCs behave a lot better now than they did, don't they? There was a lot of bad behavior on VC parts 10 years ago. I remember.
I think there's a lot more information out there, and there's a lot more transparency and ability for the people who are real thought leaders to be able to express themselves in a meaningful way. So things like Twitter and Quora, you look at what like Fred Wilson has done with blogging, and being able to say, hey, look, this guy's,
he's got
he really can add a lot of value. I mean, the one thing I would say on the whole venture thing is it's not like you can value venture portfolios on a day-to-day basis. At the end of it might be 10 or 12 years before you really know the ultimate performance of the fund. So some of the whole thing is overblown. LP money flowing in is an imperfect indicator and often a lagging indicator. I think the one thing the industry has learned is that it's not a business that scales well. So there's, I can only work with so many companies. I can't double the amount of money I put into those companies without changing the nature of what I do. And there's only a certain size partnership that makes sense. There are people who try and expand that in clever ways, and maybe they'll crack the code or maybe they won't. But in general, I think venture firms have certain limits, and we probably got over those over the last 10 years, and I think you're seeing funds coming back.
So what is the limit? It seems like everybody wants a $200, $300, $400 million fund now, and everybody's afraid to break into the $1 billion fund because that just creates too much risk. Except maybe Mark Andreessen, who seems to love the $1 billion fund.
I would say $50 million a general partner is a rough rule of thumb for what I think.
$50 million per partner. And how many startups should they be on the board of, ideally?
I think it really varies. They demand different amounts of time at different stages. I think a seasoned venture capitalist can probably work with 6 to 8 companies on the board, and probably another 4 or 5 where they're a board observer or maybe a more passive thing. So
basically,
like
gives them
when we did Yammer's last round, right? We weren't. I wasn't as involved at the board level, so it was more. That one took less time.
Jay, you're on both sides of the table.
Yep.
What do you think entrepreneurs should focus on when selecting a firm and/or partner?
Someone who can add value more than money. So someone who has invested in spaces you've been in or has worked in that space. You're alluding to it. Money's pretty easy right now, but getting that additional support is really what's going to help you be successful.
And what's the best techniques for figuring out that this person, this venture capitalist, is going to add true value on the board? I mean, do you talk to the previous entrepreneurs they've worked with? How do you determine that?
I mean, I think it's a relationship thing, and that's one of the challenges with the speed of deals happening right now is, how well can you get to know someone in 3 or 4 weeks, right?
Shotgun weddings.
Right, exactly. And most of those don't work out too well. So, I think it's slow it down and, get to know the people and work with them and, before taking that check. And, it's a lot harder for the entrepreneurs to end a relationship with the VCs than vice versa. The VCs have the upper hand typically. They have the money, and they can make life a little bit more miserable for the entrepreneur.
Okay, so now it's time for the honesty as we wrap up on the panel. You're each going to tell me the worst story of a VC behavior on a board that you ever witnessed or heard. Give me the worst.
Everybody?
Everybody's going to do one. You know, obviously, I don't want you to say, like, I was on a board with Wesley, and he showed up drunk to the board meeting. But what's the worst behavior you've seen? Like,
I don't know.
I mean, I had a VC fall asleep while I was pitching him.
I don't know. For fairly mature.
I'm not kidding, and it's a top 10 VC.
That happens all the time, though. So.
Yeah, that's pretty par for the course for me.
Like a VC questioning a fairly mature company on their use of database technology, like, you know, where that was the core part of what they did was, and recommending a course of action on what they should do to solve their problems when that wasn't a problem area. You know, that was recently, so I could just.
And you'd file that under
just like
not getting it?
Yeah, just like, shut up, don't say that. You know, just, you know, there's
Trust the
10,
entrepreneur.
15 other people in the room who probably asked that question, or the people who invest in this company probably did all that. And, you know, let's give the company some credit. This is a 250-person company.
Yeah,
So,
it probably.
Yeah, just like, you know, that kind of behavior.
Right. Did he ask him about the phone system? Okay, next.
Trying to kill an acquisition because they weren't happy with their returns. And if the acquisition didn't happen, guaranteed the company probably would have been out of business within 6 months.
Wow. So they tried to kill. And how does a VC go about trying to kill an acquisition?
Very persuasive.
With who? The acquirer?
With the CEO.
Oh,
And, you know, pushing for a direction that was obviously wrong for the company because they were in fundraising mode and it wasn't going to look good for them to have an exit that they didn't lose money on, but they also didn't make money on.
wow. So they're going
That was a
out
tough
raising
one.
a fund and they're trying to kill a deal.
This
Wow.
was supposed to be one of their winners, and it wound up not panning out as planned.
Josh?
I've seen a VC convert all of their shares to common so that they could control the common vote and replace the common directors.
And they have the right to do that.
They walked, I mean, they ran the math and they realized their liquidation preferences matter, but they, most preferred stock is convertible at the holder's option to common stock. It would almost never happen outside an IPO. They did this and then they fired the CEO and voted the other common directors out.
Wow. That is some gangster shit.
Pretty bad.
Jeez.
Backhand.
Try that at my company. Fish is going to show up on your doorstep.
Yeah.
Go ahead.
We were co-investors. We were pretty pissed.
I've seen some of this all happen. It's really bad. But the worst thing is when a VC tells an entrepreneur, I'm here to be helpful, and doesn't show up after they give them the check. That bugs me to no end. You know, when I build seed coalitions and, you know, I invest with anyone up on here, we all show up and we are all helpful. You know, it's a solemn promise that I make to the founder that, you know, we're here to be helpful, which is why we have 60+ people on our fund. But, you know, it's just, nothing bugs me more when somebody says, I'm here to be helpful, they give them the check and give them the investment and then, you know, disappear afterwards. So my one advice to everyone in the audience who's looking to raise money, do your homework, talk to the founders that the VC's invested in, you know, ask them for the VCs that, ask them for the companies where they didn't have a good experience go talk to them. You know, your VC should still behave well, even in the worst deals or the ones where they lost money. So it's always
That's actually what I
important thing to
did when I
homework.
was selected roll-off from Sequoia was he said, I can give you some references. I was like, I've called 7. He said, oh, good, I've called 6 on you. It's like, wow, we're perfect for each other.
Yeah.
We had each called the references. It was pretty good. Listen, this is great. You guys have been very honest. And, you know, at the event, we have our choice of people to come and judge and speak. And, you know, we really do our homework in picking people who we know through your founders and the people you work with. We know you guys are loved by your founders, and you gave great advice today. So let me just thank you again for sharing all this information about the enterprise and being so honest about venture capital. Big round of applause. This was very informative for me. And we're going to start the next panel, so give us just 3 minutes for a stage change.
Thanks, man.
Good job. Well done. Thank you, sir.